No, first of all, we increased our sales by about 10%. We increased the revenue by 15%, but we increased significantly our profitability, EBIT, by about 40%. So, for the very first time in our entire history, and that reaches back 100 years, we have a double-digit return on sales quarter. So we are pretty proud of what we could have delivered this quarter.
So what is the key factor here then, with profits only being slightly better off than a year ago? I mean, is that really just cost pressures really hitting the business? At the same time, we've also seen a drop-off in incoming group orders year on year. Will this be a slight concern amid the higher interest rates that we are seeing in the market and tougher financial circumstances?
Two aspects. First is looking back. We are doing better than the prior year, I would say mainly out of three reasons. Number one, we continue to improve our business structure, our efficiency. I think this is an ongoing task we took on a couple of years ago, and we are right in the middle on a very successful path. Secondly, our service income is growing significantly. And third, certainly the sales at higher prices, strong sales at higher pricing helps the bottom line as well. So those three factors, each of about a third, accounts for our good results in the quarter. Looking forward, the order intake at the moment does not give an indication or the wrong indication. We are basically sold out for this year. We haven't opened the order books for next year, neither in Europe starting from the second quarter, nor in North America at all, nor for the Japanese markets. So I expect the moment we open the order books for next year, that then we see a surge in orders. So I'm not concerned at all. All the vibes we get from our dealers and customers are positive about next year. So no reason for me and my team to worry.
Martin, we heard from you not long ago, within the last month, you upgraded your guidance back in July, also announced a pretty massive share buyback program. This morning, shares are reacting in a lackluster way to the full update for the market. What's changed between your July upgrade and today that's worth noting for investors?
Nothing changed. We are fulfilling, improving what we announced 2 weeks ago, where the markets extremely positively reacted to. Secondly, we'll start pretty soon with our share buyback. And I would say this morning's reactions of the market is not a direct reaction of our announcement. I would say that's kind of a technical reaction. I think we fulfilled all the expectations and rather over-fulfilled their expectation. There was not a single negative aspect in the calls we had and the question that we were asked.
Okay, thank you for the color. And it is worth noting that over the last 3 months, shares are up nearly 12%. So useful context for sure. Martin, let me just dig into your capital allocation policy and shareholder return policy. You did announce this share buyback just 2 weeks ago. At the same time, clearly it sounds like you've got robust demand in the pipeline. How do you think about, or how do you go about deciding what to do with your excess capital? Why is it the right decision to return this cash to shareholders rather than reinvestment in the business?
I mean, first of all, we definitely reinvest in business. We have an investment program that amounts to about $3 billion every year in the years to come. We have a lot of exciting projects in the pipeline, and we launch a lot of exciting products in a record pace. But we are an extremely sound and solid company. We have no net debt. We have a really good liquidity. We have a high incoming cash conversion rate from our EBIT. We are a profitable company. And if you are a sound and solid and healthy company, then everyone can benefit. Our people, potentially some might remember, we shed out a record bonus to every employee in Germany. We invest a lot. And last but not least, our shareholders should benefit as well. We had a good dividend in May, and we now start the share buyback. And I'm pretty confident about the dividend for next year. So this is what a healthy company can and will do, and we are a healthy company.
Sure. Martin, very quickly, you cited Asia as being a good part of the business that has added to it here. Do you see that still continuing despite China having somewhat of a weakened stance with regards to its comeback post-COVID-19?
I mean, you are fully right. The one market that concerns us is the Chinese market. That still continues now in the second year in a record low, and we have the feeling it can continue for some time. Fortunately, you can say China is not a big market for us. It's rather small. It's a joint venture with a Chinese partner, so it's a little bit farther away from the mother company, so not of a concern for Daimler Truck AG.
Sir, thank you for taking our questions. As always, Martin Daum, CEO of Daimler Truck. Coming up on the program, BP CEO Bernard Looney welcomes the UK government's decision to grant drilling licenses in the North Sea, but warns the energy transition must be rapid. We'll have more next.
The UK government has announced that it will grant hundreds of new licenses for oil as well as gas extraction in the North Sea, with the first new permits due to be issued this autumn. The government says the move will boost energy security as well as reduce dependencies on foreign powers. But the decision has faced criticism over its climate impact. Conservative MP Chris Skidmore, who chaired a government net zero review, said issuing the licenses was, quote, the wrong decision at precisely the wrong time. Prime Minister Rishi Sunak told our sister channel Sky News that the move is consistent with the government's climate goals.
Even in 2050, when we are at net zero, it is forecast that around a quarter of our energy needs will still come from oil and gas. That's why technologies like carbon capture and storage are important. But what is important then is that we get that oil and gas in the best possible way, and that means getting it from here at home. Better for our energy security, not reliant on foreign dictators. Better for jobs, for example, 100,000 supported here in Scotland, but also better for the climate, because if we're going to need it, far better to have it here at home rather than shipping it here from halfway around the world with 2, 3, 4 times the amount of carbon emissions versus the oil and gas we have here at home. So it is entirely consistent with our plans to get to net zero.
BP CEO Bernard Looney spoke to Squawk Box and gave his take on the UK government's energy strategy.
We're very much involved in the North Sea, and as you quite rightly point out, have been for many decades. It's a great part of our company, and I expect it to be a great part of our company for many decades to come. We're supportive of policies which recognize that the transition must be rapid and the transition must be orderly. And to do that, we have to invest into today's oil and gas system. In the UK, that means investing into the North Sea. We've got a 5-well campaign in the west of Shetlands, drilling 5 new wells. We're bringing on a new project in the North Sea called Seagull later this year with our partners. So that's that part of the strategy. And then more broadly, at the same time as it being an orderly transition, we want it to be rapid. And therefore, we need to invest in accelerating the transition. And in the UK here, there's probably no better example. And I think we have probably the most diversified energy strategy, energy transition strategy of any company. We're investing here in the UK in solar, in offshore wind, in hydrogen, in CCS, in